So now I move on to the liquidation model or waterfall analysis part of this course. This refers extensively to the cap table portion of the course and works off of all the calculations done there. So make sure you have the cap tables portion of this complete before doing this section of the course, or else it's going to be really difficult to do. There's a little bit more advanced Excel formulas in this liquidation analysis section, but stick with me. I'll try and go slow and we'll get it done. The beautiful thing about this is you really only got to do it for one column and then drag it over to all the rest. We just got to make sure we get it right in that one column. So this is going to be a little more advanced logic, maybe a little bit harder to follow, but is a key part of understanding all the economics involved in the term sheet and the cap table and everything else. So here we go. I'm going to start with a little bit of overview and then we'll get into building the actual model. Just as an overview, and this may be a little bit redundant because I think I did this in the intro as well. In the liquidation model or the waterfall analysis, those two terms are used interchangeably, or I use them interchangeably. What we do is we start with last money in at the top and then work our way down to the previous round. So in our cap table scenario, last money in was Series B, and then obviously Series A before that, then Series Seed, and then the common and the options. So each class or each series is a different class of preferred shares that are issued at later dates. And generally it's last money in, first money out. And the reason for that is that the last money in can decide whether or not to fund. And so that gives them the negotiating power in order to say, if we're going to invest now, we want to get our money out first in any sort of liquidation event. And that really matters in down round scenarios, mostly whenever the company is liquidated for a price that is higher than the valuation that was last invested at. Liquidation preferences generally won't get triggered, so it doesn't matter as much. It's more that the investors are protecting their downside. And so the Series B will start and get their money back first, and we'll calculate how much they get based upon whether they convert to common or take their liquidation preference, and figure out the threshold at which they take their liquidation preference and which it's more beneficial for them to convert to common. And that could have several different factors that plays into that liquidation preference multiple, whether or not it is participating, and how much the cap is if they are participating. So we'll model all that out and we'll let the spreadsheet eventually calculate for us automatically based on dollar return alone. I can't imagine there being a scenario where an investor would take less dollar-wise in order to enact their liquidation preference, but it may happen. This spreadsheet is going to be based completely on logic and dollar return. Then we'll move on to the Series A and calculate the same thing. It's calculated essentially the same way, except it's calculated off of the residual that's left for others by the Series B. And then we'll move down to the Series Seed and do the same thing, and eventually the common and options. And then we can actually break it out by entity, the proceeds by entity. And we'll do a couple of checks to make sure that we have the right amount, and we'll let the spreadsheet do a little bit of calculating for us, make sure we get all yeses here and all checks out here to know that everything's calculating correctly. And that'll be about it. So I don't think this is going to be as many videos as the cap table portion of the course, but I think it will be a little bit more complicated through the shorter videos. So yeah, let's get to it.